Oh boy, people, I can feel it. A big move is coming here. It is coming. The market's been going sideways. A lot of pinging back and forth. It's been crazy. Oh my gosh. Today's video is going to be quick. It's going to be to the point. I want to point out just the overarching theme here. The market is overall in 2023 in bullish context still. We are in a bullish consolidation, but there are many bearish signs from a macro standpoint and even from an intermarket standpoint that keep piling up. So we must stay on guard. We're going to go through this very quickly. Let's get into it. All right, everybody, welcome back. So, back month versus front month volatility. We reached above 1.2. It's marked tops in these bear market rallies since the bear market rally has started. So, are we reaching back into the territory where obviously the VIX is just being suppressed like crazy? It was OpX for the VIX today. You can see it's at that lower Bollinger Band on the weekly time frame, and the back month versus front month is now over 20% above the VIX, okay? And that's marked topping points. If we take a look at BPSPX chart, it's an overbought condition. If we take a look at discretionary, it's an overbought condition. If we take a look at financials, it's an overbought condition. If we take a look at growth relative to value, it's below a zero rate of change. You can see these red lines on the screen. They've marked turning points in that or periods of consolidation which it's currently in. If you look at the NASDAQ advanced decline line, we've thrown a couple breadth EMAs, the 21 and the 50. You can see we have a high and lower highs here, and it's pointing down still below zero. You want it above zero. We have a high and a higher high. That is a negative divergence there in breadth. If you take a look at the value line geometric index, it is not matching with the S&P 500. The last time that we didn't have it match was right over here in December, and we saw the market very well resolve to the downside. The last time we had that negative divergence was here, and we saw the market, that was the market top actually. This also works for both bullish divergences as well that we've seen. Not Netflix. Netflix did report earnings and it looked like crud, but it only finished down around 10 points. Tesla reported after hours and it looks like it's horrible, but it hasn't even tagged the lower expected move, which was roughly around $14. But overall, earnings did not look good. I'm not going to go through those numbers because it honestly doesn't matter. I just pay attention to these expected moves because I am more of a trader, at least right now. If we take a look at the dollar still remains bid as it stands, consolidating just like the S&P 500. Either this is going to break to the upside or break to the downside, and watch for the S&P 500 to do the opposite, right? Because of that very strong negative correlation. Today, the 10-year yield moved up, which was technically an opportunity to look to buy bonds, and I'll tell you why momentarily, but we know that in the zones that we track, the 10-year yield was coming to the top end, the bonds were coming to the low end of that. TLT, right? If bonds go down, TLT can go up. We're currently from a bearish trajectory, right? And the moving averages are starting to flatten out and neutralize, which could say to us that we're transitioning from a stage 4 decline to a stage 1 accumulation to potentially a stage 2 markup phase, which is a bull market in bonds. What would that mean? Well, that means we're in stage 1 of the business cycle. Don't get it confused with, stage 1, 2, 3, 4 over here. What I just pointed out, this is the economic business cycle here. Bonds go up in stage 1. Stocks and commodities typically go down. It shows the economy contracting and bonds turning up as interest rates decline. Economic weakness favors loose monetary policy and lowering of interest rates, which is bullish for bonds. Well, as it stands right now, you can look at the Fed watch tool, and although we're pricing in another 25 basis point hike, they do look to see the market or the Fed reducing rates in the near future. Now, expected moves are incredibly important. Why? I'm going to keep on continuing to show these because of just how important they are. This is Bookmap. Bookmap is some excellent software if you want to see behind the candlestick and where orders are actually hiding out to be more accurate in your intraday trades. This is stuff that I use all the time. They offer my subs a discount. Now, we showed this on yesterday's video. 41.54 was the expected move down over here. 42.01 was the expected move, the upper. What happened? Well, you can see price right before the pre-market or before the market opened up. Look where it tagged. It tagged into that lower expected move, and we started moving up from that area. What can we expect going into tomorrow for Bookmap? Actually, before I even go into that, Take a look here at this expected move for the Qs. The Qs opened up the day down, and that marked the low point right at that 316.25, which we talked about in yesterday's video. And while it came down here, I didn't want to just jump in long right away, right? We can have 2 standard deviation moves, so I waited for price action to consolidate. It started to look like this on the 1-minute chart, started to base out. This is right here at that month-to-date anchored VWAP. I posted that on the Discord channel, and then once we broke through that level, it created a nice rally of higher lows all the way up there, which was a pretty solid run. This isn't the updated Qs, but I did catch that run. Let's go back into where Bookmap, where some orders are hiding out. 4160 is some orders hanging out there since the close of the business. As far as expected moves for ES, look at 4145 to the low end, which is also by a little bit of an order spike over there. And then obviously 4191, which is over here by some orders hanging out as well. We still have 4200, 4197, those areas of orders as well. If we take a look at the SPY on the daily time frame, we're still within this rising wedge structure continuing to contract as things get very, very tight. Remember, contraction leads to expansion. And let me be honest with you, right? As the VIX is being suppressed, this typically leads to nice, small, bullish days. But if it spikes, we can see one day take out 1, 2, 3, 4, 5 trading days, right? If we open up, or if we gap down, or if we just have a bad day and we open up and we close down here, that would wipe out 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, something like that amount of trading days. Pretty wild. Now, if we take a look at the 15-minute time frame, the lower daily expected move going into tomorrow is 411.60. The upper is 416.68. Let this chart on the 15-minute time frame remind you why the bulls still have control. We have a series of higher lows, stair stepping up, okay? We also have a series of what? Higher highs, right? Stair stepping up. Albeit, yes, it looks like it's getting a little tired, but it still remains above the 5-day inclining moving average, the week-to-date and the month-to-date anchored VWAP right there as well. So if we do get a hit to the downside, start paying attention to around 411.60, which actually I don't have this on my chart, but if I were to anchor a VWAP to the monthly low point in April, the month low, that actually comes right to around this area over here. So that could be a very good area of confluence if we get a move down there coming into tomorrow's trading session. If we take a look at the Qs, still remain in the chop box, consolidating, building open interest. I think that we're going to see an explosive move to the upper or the lower weekly expected move at some point. If we don't, right, last week we didn't touch either the weekly lower or the weekly upper, and the week prior we didn't, and that is a pretty rare occurrence overall. It's even more rare if we don't touch it 3 weeks in a row, which, you know, is always a possibility, but that's just crazy. Now, if I take a look at IWM, also, bulls remain in control, right? Above the week to date, above the month to date, above the 5-day moving average. And it's kind of in this contraction pattern, right? Mark Minervini calls these volatility contraction patterns. You can also call them an ascending triangle, right? You can see a big dip, but then it gets up, and then we start to kind of put in a higher low, and then we start to put in a higher low. Volatility is clearly contracting here. So if it starts breaking up, it opens the door for the upper weekly expected move. So that's a possibility there. Now, I don't have the daily chart, but the daily chart looks like a pretty large rising wedge, similar to the SPY. If we take a look at the DIA, this thing is coiling up like crazy the last 3 days. So I'm expecting an explosive move down to the lower monthly the monthly anchored VWAP, or potentially even the lower weekly expected move if it gets below that level. Now, if we start breaking back up to the upside, which we're currently above an inclining 5-day moving average, we're basically on it. We're right below the week-to-date anchored VWAP. So if we start breaking through this and getting back above this level, this opens the door to come to that 341.97 level. Just be aware of the components in the DIA. This is the Dow Jones, right? This is the diamonds. Because some of the bigger names that are reporting earnings can obviously affect the overall performance of these index products. That's all I got for you on today's episode, everybody. Hope it helped out. See you later.